If you're getting ready to apply for an SBA 7A loan to start, grow, or acquire a small business, you're gonna wanna watch this video because the SBA has introduced sweeping changes to their main small business loan program, the 7A. Now, some of these changes are good, some of these changes are bad. But as always, I'm gonna peel back the curtain and reveal what's actually going on in the world of small business lending. Hey, I'm Drew, an actual SBA lender, and in this video, I'm gonna highlight the 8 biggest changes to the SBA 7A loan program. And stick around to the end because I'm gonna share one massive change you probably haven't heard of, but it's an absolute game changer. So back in May, the SBA put out what's called a procedural notice, which went into immediate effect, and that was our first taste of these new SBA guidelines. The notice was so abrupt and unclear that half of the SBA lending community essentially ignored them and just went on with business as usual. As you can imagine, this created a lot of confusion because if you're a small business owner, you're looking to get an SBA loan, now you're being told all these different things from all these different lenders, and no one really had any idea what was going on. But wait, it gets better. A couple days later, SBA dropped an entire new SOP, which went into effect August 1st, 2023. The SOP for us, it's like our Bible. It's the rules of the road. It's not all black and white, but for us SBA lenders that have been doing this a long time, you become familiar with how to navigate the gray. Only problem is, the whole damn thing was gray. There was contradictions within the document, and we were left with more questions than answers. So July comes along and the SBA tells us they're gonna fix it by issuing a technical update prior to that new SOP going into effect on August 1st. Well, that didn't happen. So for the last 3 months, SBA lenders have just been winging it. Again, creating a lot of confusion and uncertainty for small business owners. Well, folks, the day we've all been waiting for is finally here. Our prayers have been answered. On October 24th, the SBA issued a brand new SOP. Yes, another SOP, and it goes into effect November 15th, 2023. Now, this is all a lot to keep track of, even if you're immersed in it every day like I am, but that's why I'm here, to break it all down and tell you what's really important. Massive change number 1, equity injection. The SBA has removed all their minimum equity injection requirements except for with change of ownership transactions. So whether you're starting a business, buying real estate for your business, opening a second location, the SBA is not mandating that you bring any cash to the table. But don't get too excited. Just because the SBA doesn't require it doesn't mean your bank won't. Now, when it comes to a complete change of ownership, in other words, a business acquisition, where you're gonna acquire 100% of a business, whether stock purchase or asset purchase, the SBA does require a minimum equity injection, and it's 10%. And that's been the case, only now the rules are a bit more flexible with what can count towards that 10%. Yeah, bringing cash is still an option, but so is seller financing. In fact, the entire 10% can theoretically come from seller financing if that seller note is on full standby for 24 months, meaning no payments being made for that first 2-year period, followed by a fully amortizing term, so like a 5, 7, 10-year term after the 2-year standby. Now, does this mean folks can go out and buy businesses with no money? Probably not. It's gonna be up to the bank, and most banks are gonna wanna see some skin in the game. However, there are a couple examples where I think this does make sense for a lender like myself to do a deal with no cash from a buyer. And one is when the manager of the business is buying the business. We love these types of transactions. These people know the business inside and out. They have the sweat equity. They just don't always have the cash because they've been a W-2 employee for the last decade or whatever. So this is a great example of how the new SOP will allow more folks to access the American dream. Another example where I'm making loans to buyers with no cash injection is in the strategic acquisition space. Let's say you own a business and you want to buy a related business, but it's not an identical business, so it doesn't qualify under expansion. In those cases, we can structure 90% SBA and 10% seller note if it's on standby for 24 months. Now, I could do a whole nother video on equity injection, but I'm gonna keep it high level for now. But the headline is new SOP, more flexible equity injection guidelines, more access to capital. Massive change number 2, partial change of ownerships. For decades, the SBA 7A loan could only finance 2 kinds of change of ownership transactions, a partner buyout and a complete change of ownership. Now buyers can buy part of a business. When this originally came out in May, everyone got really excited at the idea of a partial change of ownership because it introduces more flexibility to the program. But then members of the SBA lending community, along with the trade organization, they said, wait a minute, isn't there a rule where if anyone's owned 20% or more of the business in the last 6 months, that person has to personally guarantee the loan? So even though the new SOP stated for these partial change of ownerships, it's based on the post-sale ownership percentages. So if the seller goes below 20, we're gonna base it off that and not have the seller guarantee essentially. But then there's also the 6-month look back rule where it's saying the opposite. So the fact that these two parts of the SOP contradicted themselves, it left most SBA lenders taking a more conservative approach and requiring the seller's personal guarantee in these partial change of ownership transactions, even when they drop below 20 after the sale. And no seller wants to do that, so it kind of rendered the idea of a partial change of ownership under SBA dead until the SBA came out and clarified verbally that no, we meant this to be for the post-sale percentages. And anyway, now we finally have the written guidance, so now it's clear. And I think just about everyone in the SBA lending space now will be of the mindset that if a seller is selling part of their business and they're gonna retain less than 20% post-close, they don't need to personally guarantee the loan. Massive change number 3, do what you do. While you won't find this phrase in the SOP, it's how the SBA is describing their new philosophy, which is to let the SBA lenders use their conventional lending policies to dictate their SBA loan policies. Hence the phrase, do what you do. SBA lending has always been a little different lender to lender, but now with the SBA stripping out so many of their guidelines and replacing it with this do what you do language, those differences are gonna be amplified. So when you go get an SBA loan, just know this is not a cookie cutter loan program. Every lender is gonna be doing different things. Massive change number 4, overhaul of the SBA approval process. For years, if we approved the loan as a preferred lender, there were no additional approvals needed. It was completely streamlined compared to non-preferred lenders who had to underwrite and approve the loan and then send the package to the SBA to underwrite and approve the loan. So everyone just worked with preferred lenders to avoid all that. But now when a preferred lender inputs the borrower information into the SBA system, the SBA is actually going in and running checks against both internal and external databases. And it's causing delays because this is a new system and the kinks are still being worked out. But so far, lenders are not big fans of this new process and neither are our borrowers. Massive change number 5, expansion of the SBA small loan program. Under the 7A program, SBA delineates between standard loan and small loan. One of the top 3 initiatives of the SBA is to do more small dollar loans. And so they've been making it easier and easier to make these small loans because SBA lenders, banks, historically, they've avoided them because they take too much work and they're smaller, so they make less money, and they couldn't figure out how to do a profitable small loan program. So SBA introduced more streamlining of these small loans, and they increased what they consider a small loan from $350,000 to $500,000, which that's huge. And we're already seeing more lenders enter the small loan arena, and I think this one is a huge win. Massive change number 6, blended terms. So when the SBA puts out a new SOP, it's not just what's in the new SOP, it's also what isn't in the new SOP. And when they issued this new SOP, they removed a part that allowed us to make 25-year terms when at least 51% of the project was going towards real estate. And so for the last few months, if there was real estate, but also other things in the loan, we had to blend the term down to like a 15-year term or something like that. And that meant a higher payment for the small business owner. But thankfully, with the new version of the SOP, this language is back and borrowers can once again get 25-year terms for multi-use projects where the real estate represents at least 51% of the proceeds. Massive change number 7, construction bonds. The new version of the SOP also brought back the ability for a lender to use funds control instead of requiring that the GC get bonded, which is super expensive. So starting on August 1, if a small business wanted to borrow $100,000 to do a simple build out, their GC needed to get a bond, which is so ridiculous that the SBA started passing out waivers for this rule. But you had to A, know you can get a waiver, and then B, get them on each deal. And so this new version of the SOP fixes that issue. Massive change number 8, fee relief. The SBA is offering fee relief in fiscal year 2024. This is great news, but only if you're borrowing $2 million or less. Under $1 million, there's no fee. That's from October 2023 to the end of September 2024. So on a $1 million loan, that's a savings of 26 grand. And on loans over $1 million up to $2 million, the fee is cut in half. And then loans over $2 million, well, you're out of luck. Clearly the SBA is trying to incentivize the small dollar loans. Now for the hidden gem. So this last one is something that not a lot of people are talking about, but it's actually a huge thing that has changed, and that is the affiliation rules. Affiliation is a term we use in SBA to determine if two entities are related to one another and if we have to kind of combine them and count them sort of together in the same bucket. And this comes into play with your $5 million cap that the SBA has. The maximum loan for an SBA 7A loan is $5 million. So if you own a business and it has a loan of $5 million from the SBA and you try to go get another SBA loan on your other business, well, historically, if you were controlling and operating both businesses, you couldn't do that because they were affiliated. It was based on control. Now, the SBA has actually put really specific guidelines in place to determine if those businesses are affiliated. And it goes by ownership, over 50%, and sector. So the first 3 digits of your NAICS code. And you have to hit both for those companies to be affiliated. So in this example where I own 2 businesses, business A, I own 51% of, and business B, I own 49% of, well, automatically those businesses are not affiliated because I don't own 51% of business B. Now, let's say I own 51% of both businesses, but one of them is a cookie manufacturer and the other is a construction company. Different sectors. Still not affiliated, because the first 3 digits of the NAICS code, I assume, is gonna be different. So what does that mean? Well, I haven't tested this out yet. We're going to be soon, but there's no reason why both of those businesses can't get a $5 million SBA loan because they're not affiliated. Now, in the coming months, as I get more experience submitting loans through this new SBA approval, I'll be more confident in saying that because I wanna actually see it, because this is just so different than what I've been doing for my 12, 13 years. But stay tuned, more to come. So what do you think? Are these changes good, bad? It doesn't matter? Leave a comment down below.